I'm about to tell you something that'll make you uncomfortable, possibly angry, but it's mathematically provable, so your feelings don't change the facts. You're poor, not because you don't make enough money. You're poor because you're mathematically illiterate when it comes to wealth. I'm James Simons, never worked in finance, never got an MBA, used mathematics that you learned in high school to build $28 billion. And today I'm going to show you exactly which mathematical concepts you're ignoring and how much it's costing you. By the end, you'll either change or you'll stay broke. Your choice. Here's the uncomfortable truth. If you're doing what everyone does with money, you're guaranteed to get what everyone gets, which statistically is not much. The median American retires with about $200,000 saved. That's 40 years of work for barely enough to last 10 years of retirement. Meanwhile, the exact same person with the exact same salary could have retired with $3 million just by understanding 4 mathematical principles that I'm going to break down today. The difference isn't luck. It's not connections. It's not even intelligence. It's mathematical literacy applied consistently over time. Most people graduate high school having learned exponential functions, compound interest, probability theory, and statistical thinking. Then they promptly forget all of it and make financial decisions based on feelings, advertisements, and what their broke friends are doing. I spent 30 years running Renaissance technologies using nothing but mathematics and data. Never once made a financial decision based on a hunch or because it felt right. Every single move was calculated, tested, and probability weighted. Result: 39% average annual returns for over 30 years with 0 losing years. Not one. You know what Wall Street's best investors average? Maybe 12 to 15% if they're legendary. The difference is, I treated money as a mathematical system, not an emotional journey. And here's what's crazy. The math I used is simpler than what you needed to pass high school algebra. I'm talking about concepts a 10th grader can understand. But nobody teaches you how to apply them to wealth building, so you end up working twice as hard for half the results. If you want to learn to think mathematically about money, to see patterns that 99% of people ignore, subscribe to this channel right now. What I'm about to show you isn't opinion. It's not market feeling. It's not guesswork. It's pure mathematics applied to wealth building. Most people prefer gurus who talk pretty and promise quick riches. You prefer numbers that work? Hit that subscribe button. Today, I'm giving you 4 specific pieces of advice. 4 mathematical principles that if you apply them starting today, will mathematically guarantee you end up in the top 5% of wealth in America. Not motivational nonsense. Mathematical certainty. Let's begin with the first one, and it's going to challenge everything you think you know about how money grows. Most people come to me and ask how they can make more money. That's the wrong question. The right question is, how do I make my existing money multiply itself faster than I can earn it through labor? See, there are 2 types of growth in this universe: linear and exponential. Linear growth is what you get from working. You work an hour, you get paid for an hour. Work 2 hours, get paid for 2. It's a straight line. You trade time for money at a fixed rate. Exponential growth is what happens when money makes money. And then that money makes more money on itself. And that money makes even more money, creating a curve that starts slow and then shoots upward like a rocket. Here's the mathematical difference and why it matters. Let's say you make $60,000 a year. That's about $5,000 a month. If you save 10%, that's $500 monthly. Over 30 years of just saving without any growth, you'd have $180,000. That's linear. 500 times 12 months times 30 years equals $180,000. Predictable, safe, and pathetically small. Now let's apply exponential mathematics. same $500 per month, but instead of hiding it under your mattress, you invest it in a simple S&P 500 index fund that historically returns about 10% annually. After 30 years, you don't have $180,000. You have $1,136,000. Same effort, same 500 monthly. But exponential math multiplied your result by 6.3 times. That extra $956,000 is free money that came from understanding one mathematical principle: compound interest. But here's where it gets really interesting. Most people hear that and think, okay, great, I'll start investing. But they do it wrong because they don't understand the second principle, which is that time in the market beats timing the market every single time. And this isn't my opinion, it's statistical fact. Let me show you the data. From 1950 to 2025, the S&P 500 had an average annual return of about 10%. Sounds good, right? But here's what people miss. That average includes massive crashes. The 2000 dot-com bubble, where the market dropped 49%. The 2008 financial crisis, where it dropped 57%. The 2020 COVID crash, where it dropped 34%. And yet, despite these catastrophic drops, the average is still 10% because exponential growth always recovers and exceeds previous highs given enough time. Now, what do most people do? They try to avoid the crashes by timing the market. They think they're smart. I'll invest when it's low and sell when it's high. Sounds logical. Except the mathematics prove it's nearly impossible to execute successfully. A study by Dalbar Incorporated analyzed investor behavior over 20 years and found that the average investor earned 5.3% annually, while the market returned 9.8%. Same market, same time frame. Why the difference? Because people pulled money out during crashes and missed the recovery days. If you missed just the 10 best days in the market over a 20-year period, your returns dropped by 50%, just 10 days out of over 5,000 trading days. The probability of correctly predicting which days those will be is effectively zero. So here's the mathematical advice. Stop trying to be smart about timing and just be consistent about time. Invest the same amount every single month, regardless of what the market is doing. When the market is high, you buy fewer shares. When it crashes, you buy more shares at discount prices. This is called dollar-cost averaging, and it's the mathematically optimal strategy for anyone who can't predict the future, which is everyone. Let me give you a concrete example. Two people, both 30 years old, both have $500 a month to invest. Person A tries to time the market. They invest when they feel confident, pull out when they get scared, miss some months entirely. Over 30 years, their sporadic investing and poor timing gets them about 6% average returns. Person B doesn't even watch the news, sets up an automatic investment of $500 monthly into an index fund and forgets about it. Gets the market's 10% average. At age 60, Person A has about $500,000. Person B has $1,136,000. Same starting point, same monthly investment, but Person B has more than double the wealth because they understood that consistent time beats clever timing. This brings me to the second major piece of advice, and this one is going to make a lot of people angry because it contradicts what the entire financial industry wants you to believe. The second principle is this: complexity is the enemy of wealth. Simplicity is the weapon. Wall Street makes billions convincing you that wealth building is complicated, that you need expert advisors, actively managed funds, sophisticated strategies, and insider knowledge. All lies designed to extract fees from you. The mathematics are brutally clear on this. Index funds, which are simple baskets that hold all the stocks in a market and require zero management, outperform 92% of actively managed funds over 15-year periods. 92%. These actively managed funds have teams of Harvard MBAs, real-time data, sophisticated algorithms, and they still lose to a simple index fund that costs 0.03% in fees and requires zero expertise to own. Why? Because mathematics doesn't care about your pedigree or your complexity. It cares about cost efficiency and time horizon. Every percentage point you pay in fees is a percentage point that can't compound for you. Let's quantify the cost of complexity. You invest $500 monthly for 30 years. Option A, you use a simple index fund charging 0.03% annually. Option B, you hire a financial advisor who puts you in actively managed funds, charging 1.5% annually, which is actually low for the industry. That 1.47% difference in fees doesn't sound like much, but let's do the math. Option A at 9.97%. Net returns after fees gives you $1,125,000 after 30 years. Option B, at 8.5% net returns after fees, gives you $745,000. The complexity and expert advice cost you $380,000 over 30 years. That's not a typo. $380,000 extracted from your wealth through fees, paying for fancy offices, advertising, and advisor salaries. The simple approach using basic index funds and doing nothing would have made you 51% wealthier. This is why I never used complexity at Renaissance. Yes, we used sophisticated mathematics, but the underlying principle was always elegant simplicity. Find patterns, execute consistently, minimize costs, maximize time. When people ask me what funds they should invest in, I tell them the same thing I told my family. Put it in a low-cost S&P 500 index fund and don't touch it for 30 years. That's it. That's the whole strategy. Boring? Absolutely. Effective? Mathematically? Guaranteed. But here's where human psychology fights mathematics, and psychology always loses in the long run. People hate simplicity because it feels like they're not doing enough. They want to feel active, engaged, smart, so they trade stocks, chase hot tips, buy cryptocurrency based on tweets, switch funds constantly, and all of that activity destroys wealth. There's an inverse correlation between activity and results in investing. The more you do, the worse you perform. It's counterintuitive, but mathematically proven. Vanguard did a study showing that investors who logged into their accounts less frequently had higher returns than those who checked daily. Why? Because daily checkers panic during normal market volatility and make emotional decisions. Weekly checkers see less volatility and stay calm. The best investors? They set it up and literally forget their password. Let me tell you about my friend, a professor who started investing in 1985. Put $500 a month into an index fund. Never checked it. Didn't even know his account password. 40 years later, went to retire, logged in for the first time in decades, and had $4.2 million. He didn't earn more than other professors. He wasn't smarter. He just understood that doing nothing is mathematically superior to doing something when it comes to long-term investing. This leads directly into the third principle, and this one separates the mathematically literate from everyone else. The third piece of advice: understand that your biggest wealth-building asset isn't money, it's time, and most people are squandering it. Compound interest is often called the eighth wonder of the world, and once you see the mathematics, you'll understand why. The formula is simple. Final amount equals principal times 1 plus rate raised to the power of time. That exponent, That time variable raised as a power is what creates exponential growth. But here's what most people miss. Because time is an exponent, early years contribute massively more to final wealth than later years, even though you're investing the same amount. Let me demonstrate this with numbers that will probably shock you. Person A starts investing $500 a month at age 25, stops at age 35, only invests for 10 years, total invested $60,000, then doesn't add another penny, but leaves it growing at 10%. At age 65, they have $1.58 million. Person B waits until 35 to start, then invests $500 monthly from 35 to 65, full 30 years. Total invested, $180,000, 3 times what Person A invested. At age 65, Person B has $1.14 million. Person A invested $60,000 over 10 years and ended with more wealth than Person B, who invested $180,000 over 30 years. How is that mathematically possible? The exponent. Those extra 10 years at the beginning gave Person A's money 20 extra years to compound. The money invested at age 25 had 40 years to grow. The money Person B invested at age 35 only had 30 years. That 10-year difference in the exponent multiplied Person A's smaller investment into greater wealth. This is why I tell young people, your 20s aren't for spending every dollar you make on lifestyle. Your 20s are for capturing time in the exponent. Every year you delay investing is a year you can never get back in the compound interest formula. And that missing year costs you more than you can imagine. Here's another way to visualize the power of time. If you invest $10,000 at age 25 and never add another dollar, at 10% annual growth, you'll have $452,000 at age 65. If you wait until age 45 to invest that same $10,000, you'll have only $67,000 at age 65. Same $10,000. The 20-year delay cost you $385,000. That's not about working harder or earning more. That's purely about understanding that time is the most valuable variable in the wealth equation, and you cannot buy more of it. You can always make more money. You cannot make more time. So what's the practical application? Start now, not tomorrow, not when you feel ready, not when you understand everything. Now, even if it's $50 a month, even if it's $25 a month. The mathematics don't care about the size of the number. They care about the length of time that number has to compound. I've seen people waste 5 years waiting to invest until they could afford to invest more, and those 5 years of waiting cost them more than all the extra money they eventually invested. It's mathematically backwards. Small amounts invested early beat large amounts invested late almost every time. But here's what trips people up. They think they need a lot of money to start, so they wait. Or they pay off low-interest debt first before investing. Or they build a massive emergency fund before investing. All of these delay tactics are costing them the most valuable asset in the compound interest equation. Let me be clear, I'm not saying don't have an emergency fund or ignore high-interest debt, but I am saying that the mathematical priority should be capturing time first. Open the investment account today, even if you can only put in $20 this month. Start the compounding clock. You can always increase the amount later, but you can never recover lost time. This concept of time as the critical variable leads us to the fourth and final principle, and this is the one that built my $28 billion. The fourth piece of advice is this. Wealth isn't built by avoiding risk. It's built by understanding probability and acting accordingly. Most people treat all risk as binary. Either something is safe or it's dangerous. That's not how mathematics works. Everything has a probability distribution. Nothing is absolutely safe. Nothing is absolutely dangerous. The question is always, what is the probability-weighted expected outcome? Let me show you what I mean. People think putting money in savings accounts is safe. Mathematically, it's guaranteed wealth destruction. If your savings account pays 1% interest and inflation is 3%, you're losing 2% of purchasing power every year. That's not safe. That's certain loss. You're taking 100% probability of losing 2% annually in exchange for the psychological feeling of safety. Now, compare that to investing in an index fund. Yes, it goes up and down. Yes, you could lose money in any given year. But over every 20-year period in market history, stocks have never had negative returns. Never. The probability of loss over 20 years is 0, based on 100 years of data. So which is actually safer? The guaranteed 2% annual loss in savings, or the 0% probability of loss over 20 years in the market? Mathematics says the market is safer, but human psychology says savings feels safer. Whenever psychology and mathematics disagree about money, mathematics wins and psychology goes broke. This is the core insight that built Renaissance technologies. We didn't try to eliminate risk. We tried to understand probability better than everyone else. We'd take 1,000 small bets where we had a 51% probability of being right. Didn't matter if we were wrong 49% of the time. Over thousands of trades, that 2% edge compounds into billions of dollars. You don't need to make those 1,000 bets. You just need to understand one probability fact. The stock market goes up over time with about 95% certainty over periods longer than 15 years. That's not a guess. That's 100 years of data across every economic condition: war, pandemic, recession, and crisis. The math is clear. Quick curiosity of mine. I want to map where the people who think differently are located, who prefer data over hot tips. Where are you watching from? Drop your city and state in the comments below, or your country if you're outside the US. I'm genuinely curious to see the geographic distribution of people who actually want to understand the numbers behind wealth. Let's create a mental map of where the independent thinkers are. So let's talk about how to apply probability thinking to your specific situation. Most people ask, should I invest now or wait for a crash? That's the wrong framing. The right question is, what is the probability-weighted expected return of investing now versus waiting? Let's calculate it. If you invest now, you capture returns starting today. Historical probability says you'll average about 10% annually over the long term. If you wait for a crash, you need several things to happen. First, a crash needs to occur. Second, you need to recognize it's a crash and not just normal volatility. Third, you need to have the courage to invest when everyone is panicking. Fourth, the crash needs to be significant enough to offset the returns you missed while waiting. The probability of successfully executing all four of those conditions is extremely low. Studies show most people who wait for crashes end up waiting through years of gains, and then still don't invest during the crash because they're too scared. So the probability-weighted expected return of investing now is approximately 10% annually starting immediately. The probability-weighted expected return of waiting is approximately 3% annually because you'll miss most of the gains and still won't time the bottom correctly. Mathematics says invest now. But what if you invest now and the market crashes next month? Doesn't matter. Remember, we're not trying to predict the next month. We're trying to maximize the probability-weighted outcome over 20 to 30 years. A crash next month is actually beneficial if you're investing monthly because you'll buy shares at discount prices for several months. People who invested right before the 2008 crash and kept investing monthly throughout the crash ended up with higher returns than people who perfectly timed the bottom but didn't invest consistently. Why? Because consistent investing means you bought tons of shares at fire sale prices during the crash, and when the recovery came, those shares exploded in value. This is the mathematics of probability. You don't need to be right about market direction. You need to be consistent about capturing the long-term probability distribution. Let me give you a concrete example of probability thinking versus emotional thinking. In March 2020, COVID crashed the market by 34% in 3 weeks. Fastest crash in history. Everyone panicked. People sold everything. Financial news said it could drop another 50%. What did the mathematics say? Well, in every previous pandemic, war, or crisis, markets eventually recovered and exceeded previous highs. The probability of long-term recovery was extremely high based on historical data. The timing was uncertain, but the direction was probable. I told everyone I knew, if you have money sitting around, this is a probability gift. Markets are on sale. Most people were too scared to listen. But those who understood probability and invested during that crash saw their money double within 2 years as the market recovered to new highs. Same market, same information. Different outcome based purely on whether you thought in probability terms or emotional terms. This is what I mean by understanding risk through mathematics. Risk isn't about whether something could go wrong. Everything could go wrong. Risk is about the probability-weighted likelihood of outcomes over sufficient time frames. A diversified index fund over 30 years has near zero probability of loss and high probability of 10% annualized gains. That's not risky. That's as close to certain as anything in life. But put that same money in a single stock, and the probability distribution changes dramatically. Or put it in cryptocurrency, and you're in pure speculation territory where the probability of any specific outcome is essentially unknowable. This is why I always invested in diversified mathematical systems rather than concentrated bets. Diversification isn't about safety. It's about probability optimization. When you hold 500 stocks instead of 5, you reduce the impact of any single company failing while maintaining exposure to the overall growth of the economy. The mathematics of diversification show that holding about 20 to 30 uncorrelated assets eliminates 95% of individual asset risk, while retaining full market returns. More than that adds complexity without improving returns. Fewer than that increases unnecessary risk without improving returns. This is known as the efficient frontier in portfolio theory, and it's pure mathematics. So, here's the practical probability advice. Invest in broad index funds that hold hundreds or thousands of companies. You're not betting on Apple or Amazon. You're betting on the mathematical probability that human innovation and economic growth will continue, which has a 100-year track record of being correct. That's high probability. Betting on individual stocks is low probability. Betting on crypto is unknown probability. Betting on your friend's startup is near zero probability. Allocate your wealth according to probability distributions, not excitement levels. Now, let's bring all 4 principles together and see what they create when applied simultaneously. Remember, the 4 principles are: 1. Exponential growth beats linear growth. 2. Simplicity beats complexity. 3. Time is your greatest asset. 4. Probability beats emotion. Let's create 2 people and watch their financial lives unfold over 30 years using basic mathematics. Both start at age 30. Both make $65,000 per year. Both get 3% annual raises. Identical starting points. Person A does what everyone does. They save money when they can, keep most of it in savings accounts. occasionally invest when they feel confident, pull money out during market scares, pay too much in fees for actively managed funds, and start taking investing seriously around age 45, once they feel they have enough money to risk. Person B applies the 4 mathematical principles from day 1. Invests 10% of income automatically every month into low-cost index funds, starting immediately at age 30. Never stops, never wavers, doesn't check it obsessively, just lets time and probability do the work. After 30 years at age 60, where are they? Person A has approximately $350,000 saved. Sounds decent. Not bad for someone who worked hard and saved when they could. But let's look at Person B, who used mathematics instead of emotions. Person B has $2.4 million. Same starting salary, same raises, same 30 years. The difference? Person B understood exponential growth, so they invested instead of saved. Person B understood simplicity, so they used index funds instead of expensive advisors. Person B understood time, so they started immediately at 30 instead of waiting until 45. Person B understood probability, so they stayed invested during crashes instead of panic selling. Those 4 mathematical principles created a $2 million difference in outcomes. That's not luck. That's not genius. That's basic mathematics applied consistently. But here's the part that bothers me mathematically. Statistically, 96% of people who watch this will do nothing. They'll think it's interesting, maybe even agree with everything I said, and then go right back to their old patterns. That's not a judgment. That's probability. Behavioral studies show that knowledge rarely changes behavior without systems and accountability. So if you're going to be in the 4% who actually apply this, you need to do something right now while the information is fresh. Not tomorrow, not next week. Today. The mathematics of behavioral change show that if you don't act within 24 hours of learning something, the probability of ever acting drops to near 0. So, here's what you do today. Open a brokerage account. Takes 15 minutes. Vanguard, Fidelity, Schwab, doesn't matter. All good. Set up automatic monthly investments into a target date retirement fund or S&P 500 index fund. Whatever amount you can do, even if it's $50. Start the compounding clock. That's it. That's the whole action plan. No complexity. No analysis paralysis. No waiting until you understand everything perfectly. Just open, fund, automate, forget. The mathematics will handle the rest over time. Everything I've shown you today is 6th grade math applied to wealth building. Multiplication, percentages, exponents. But 6th grade math applied for 30 years beats Harvard MBAs making emotional decisions every single time. Not sometimes. Every time. The data proves it. So where are you in this probability distribution? Are you going to be in the 96% who intellectually agree but behaviorally ignore? Or the 4% who understand that mathematics doesn't care about your intentions, only your actions? The outcome is deterministic based on which group you choose. I built $28 billion on one core insight. Mathematics beats emotion over sufficient time frames. You don't need 28 billion. You probably just need 2 or 3 million to retire comfortably. And that's mathematically achievable for almost anyone in America earning a median income who applies these 4 principles starting today. The question isn't whether it works. The mathematics prove it works. The question is whether you'll actually do it. So if the math I showed you makes sense, if you can see the pattern, hit the like button right now. Statistically, only 3 to 5% of YouTube viewers actually like videos. Be part of the minority that acts on logic, not inertia. Subscribe if you haven't yet. And comment where you're watching from because I want to test if my hypothesis is correct. People who think mathematically are distributed non-uniformly geographically. Let's test it. Drop your city below. I'm James Simons. I spent 30 years proving that mathematics beats guessing. Now you have the same mathematics. What you do with it determines everything.